Thanks for joining us. I want to welcome everyone for joining our latest discussion, the building blocks of sustainability. Now, why is it we know anything about this topic? Well, FPTransitions is now celebrating its 25th year, and we've grown to a team of over 60 highly credentialed appraisers, analysts, attorneys, and consultants, providing comprehensive valuation, succession planning, M&A, and business consulting services all under one roof. This year alone, we're going to help over 200 advisors build their businesses, or other advisors maybe enhance their current businesses. We've averaged over 100 M&A transactions every year for quite some time. In our storied history, we've also completed over 16,000 valuations, providing us with substantial data and insights on a wide range of independent advisory practices, ranging from a few million in AUM to a few billion. Today, I'm joined by my esteemed colleagues, Eric Godis and Siena Halpin. Eric Godis is an MBA and Senior Vice President and Senior Consultant at FPTransitions, who was a trailblazer in founding an RIA well before it was cool in our industry. He ran multiple wealth management firms for 30 years before joining FPTransitions about 3 years ago. Today, Eric's going to share some insights learned from his own career, but more importantly, from his work in our consulting group, where he helps advisors build sustainable businesses. Siena Halpin is a senior analyst here with FPTransitions, a graduate of OSU, who happens to have yet again a dominant baseball team this season. Go Beavers. Siena graduated with a degree in finance and a minor in leadership, and both of those are put to use daily in the work that she's been doing in the 5 years she's been with FPTransitions. Her expertise lies in creating customized succession plans for advisors, things that include equity sales, M&A, and a lot of compensation consulting, which is going to come in handy for our discussion. By modeling clients' cash flows, compensation reports, and equity pathways, her work really helps support our consulting team and making it really possible for our clients to make highly informed decisions about their businesses. I'm Scott Leake. I'm a CFP professional and recently got certified as a certified exit planning advisor. I serve as the director of business development for FPTransitions, and just because it's so fun, I still kind of dabble in consulting work as well. So let's get started. Our learning objectives for the discussion today are as follows. First off is, why is there a need for sustainability? And we'll talk about that both in regards to your business individually, but as an industry, why is this important? Secondly, we're going to focus on the benefits of sustainability, and we'll talk about the various stakeholders within that. It's important for yourself and your family. It's important for your employees. It's important for your clients. We'll talk third about sustainability and its relation to value of the equity in your business. And fourth, and this is probably where we'll spend most of our time, is what are the 5 building blocks of sustainability? And then finally, we'll conclude with, how do you start creating a path to partnership with sustainability in mind? So let's start off with, why is there a need for sustainability? Well, first and foremost, there's no better way to protect what is most likely the most valuable asset any advisor owns, and that is their business. And so we want to focus on, having the right talent, having next generation advisors who are able to invest their time, money, and effort into that business. Secondly, under a multi-generational structure, founders and or majority owners are commonly referred to as G1s here at FP. They can benefit from greater control over their own businesses and their own retirement plans, as well as past their traditional retirement age, because they can effectively build and implement their own glide path to retirement. And this is going to help gradually shift them from chief revenue producer to CEO to mentor. Finally, building a multi-generational business provides structure and support for generations of clients and their assets well beyond the length of any one single advisor's career. And I would argue that our industry as a whole needs sustainability within the independent channel. I constantly am telling clients of ours about how, the captive wirehouse model still has an advantage over the independent channel, in that you can go talk to an advisor at one of the wirehouses and you can find an advisor, hire one, and you'll have an advisor for life. It might not be that advisor you hired that day, but you'll have one for life. And in the independent channel, we often are leaving our clients to go out and have to find a new advisor when we're ready to retire. We don't have that sustainability that makes it possible for those clients to stay multi-generational themselves. So it's something the entire industry needs to work on. to continue to move the independent channel forward. So I think it's incumbent upon all of us to address sustainability. So Eric, Siena, anything you want to add to those benefits or those key points of sustainability, why there's a need for it?
No, I think you summarized it really well, Scott. I mean, most of the clients that we talk to, their primary concern first is their clients, and that makes a lot of sense. Many people have family as clients, they have friends as clients, they have clients that didn't start out as friends but have become friends. So they really feel strongly about them, and they want to make sure that once their working days are done, these clients are still taken care of. Same thing sort of applies to the G2s or the next generation advisors, where so many people we work with, they've hired these advisors at a young age. They've trained them, they've nurtured them, they've mentored them. They want to make sure they have a job for life, and that's critically important in our industry. And I think what people are now realizing is, if you want to have maximum client retention and you're in your 60s, let's say, your clients are already thinking, what happens when you retire? I know I, as your client, am talking to you about my retirement. Aren't you ever going to retire? So they're thinking about it, even if they're not talking to you about it. And they want to make sure you've got the right structure and the right people to continue this business, because no one wants to look for a new advisor.
Siena, would you talk to us a little bit about, as we move on to kind of this next point of the benefits of sustainability and for all those stakeholders, for the clients, for the family, the staff, of the advisor, what do you consider to be some of the most significant benefits of sustainability for those different stakeholders?
Yeah, certainly, Scott. Great question. So I think first and foremost, for the advisor and the family associated, it really gives you a lot of options, because you get, like you just mentioned, you get to customize that glide path to retirement. So you might start, not working on Fridays or leaving early to go hit the golf range. So it gives you that flexibility, but it also, in terms of corporate governance documents that we help with in formalizing a business, it helps protect you in the case of some of those, what we would call triggering events, just to make sure that your family's protected should something happen. In terms of the employees and the culture that you've built, sustainability is making sure that you're comfortable with the culture, and those G2s that you're bringing on, they fit the culture as well. So your employees are given more opportunities for growth. And to Eric's point, a long-term career length investment with being an employee in the firm. And then we kind of hit on this for clients, but the clients are associated with the firm name rather than the individual advisor. So it's that longevity that you're providing to your clients, and that you're retaining them. It's a better retention strategy that way.
Eric, anything you want to add to that? I think Siena covered it pretty well, but you might have some additional ideas.
I think both you and Siena were spot on.
All right. Well, let's transition to talking about sustainability and its relationship to value. So the process of building a sustainable business, it often starts with changing kind of the advisor's view and mindset of value in the business. So typically we see owners, they define value based on what's the business worth to a third-party buyer. But when we're talking about sustainability and building a multi-generational business, we're talking about something that's going to outlast that one advisor's career. And it needs to have a shift in the definition and include, what is this business worth to the next generation of advisors, or the G2s, as we call them, who are investing their time, their money, and their careers in this business through a buy-in. So the value of a sustainable business encompasses far more than simply the clients and the AUM and the revenue that might be considered most important by an outside buyer. And not that those aren't important to an inside buyer, but it relies more on the long-term vision and the business's ability to perpetuate growth. This is an investable equity value that's rooted in how that entity is structured, how the revenue flows through the centralized business structure, and the profitability that it creates. So we're talking about an equity-centric business that centralizes its assets, its revenue, its expenses, and again, most importantly, the available profits, because those profits are used to reinvest in the business growth, to attract next generation talent, and thus creating a multi-generational ownership structure. This is going to allow that business to derive more value from the streamlined cash flow and derive greater efficiencies. So equity-centric businesses, generally speaking, are stronger, they're more secure, and they have a foundation from which to perpetuate sustainability. So as we talk about some of the top value drivers for advisors that might be on the smaller side who are starting out, maybe a sole proprietor, someone who's approaching maybe that 100 million mark, 200 million in AUM. Siena, what do you see as some of those top value drivers for those practice or book owners?
Great question, Scott. So I think first and foremost, you hit on this a little bit, but growth. So looking at both the historic growth and then also what you anticipate moving forward. Historic growth is important because it proves your ability to continue to grow through market fluctuations, which we often do experience in the industry. But I think perhaps more importantly is the anticipated growth that you expect. So we'll work with you to evaluate the type of staff that you have. Are you staffed for growth? If you are, then that might make sense why your profitability is a little bit lower when we first start working with you, but it helps us figure out that growth trajectory for you, which bolsters valuation. Some of the other points is, the amount of revenue that you have, so really the size of revenue, but I think also the recurring revenue that you have, because that's the most valuable asset we see in the industry, because you can rely on it on an ongoing basis. Non-recurring revenue is certainly valuable. It's just a little bit less valuable from just a simple valuation perspective because you have to do a little bit more work to keep that in the business.
Well, I
And
think
then,
that's a good point, Sienna, too, because we think about we look at the multiples in a adjacent industry like the tax industry. Like a CPA practice is going to get 1.5 times revenue multiples on that because it's such transactional revenue. You have to convince the client to come back and pay you year after year. So I think that recurring revenue is a really great point.
yeah, certainly. And that's, what bolsters the profitability, which perhaps is the most important value driver. Because, like you said, that finances buy-ins, it makes it a firm that people want to buy into and help support, debt when we think about structuring promissory notes. We need a certain level of profitability to ensure that the investors aren't taking, a pay cut to move forward with the opportunity.
Right.
And then, kind of aside from the numbers a little bit, I think having a culture of putting stock in play is also really important to valuation and driving value because it makes people want to invest. It's kind of the difference between value and purchase price. If you have a culture of putting stock in play, there's a chance that those G2 investors are willing to pay a premium to have the opportunity to become an equity owner.
Great points.
Yeah.
Eric, as we start, go ahead.
No, I was just going to make the point that on top of, everything that Sienna just said is a really fundamental shift for some firms, which is who actually owns these clients? Mm-hmm. Is it the company that owns the clients, or is it the advisor themselves that owns the clients?
Right.
Can the advisor work for you for 5 or 10 years, build up significant assets, manage 100 clients, and decide next year they want to leave and take it all with them? If that's the structure that you have, your business is inherently less valuable than those who have the clients committed to the firm. So we see a lot of businesses that starts out with one rainmaker, builds a book, starts to build some infrastructure, recruits a few advisors, and says, "Look, I've got this great infrastructure. Come leverage what I've built, and I'll pay you on a grid, and you can continue to do what you do, but use my back office support." And they do make some revenue off that advisor, and they're like, "Well, this is good. If I add 2 more, or 3 more, or 4 more, look at how much money I'm making." What they often forget and then have a hard time shifting to is if they ever go to sell their business to an external party or to a junior partner, those assets are almost worthless because they could walk out the door the next day. So how we try to coach people is to bring those assets inside, make them part of the firm, tie up these advisors. And tie up shouldn't be thought of as a bad word. It's good for them too, to commit to having their own future. And then everyone enjoys the success that the whole team has. It's a win-win for everybody.
Agreed. So let's start to get into the weeds a little bit more and talk about the 5 building blocks of sustainability. So the first one is setting up an appropriate entity structure. So Eric, we often equate the entity structure of business to the frame of a house. So elaborate on this concept for everyone.
Yeah, hard to have a good solid house that doesn't have a good framework and good supports underneath it. So I guess I'll go back a little bit because I'm sure there's some people listening that are structured as a C Corp. This was very popular 20, 25 years ago. When we see it today, before we even meet a firm, we're like, aha, I assume this firm has been around a long time. So good for you for having that longevity, but not so good for you if you're looking to bring in new partners or eventually sell this firm because that structure really has no profitability because you're paying it all out at the end of the year. So what is much more popular now in our business is structuring as an LLC, a limited liability company, which has many advantages, one of them being, the tax status, two being flexibility if you want to bring in new partners or if partners want to leave. And if you haven't considered it already, that's something you want to talk to someone like us or your CPA about because you can shift even if you've got an existing C Corp structure. So
Well, and I think
do you see that mostly as, what we recommend as the building blocks for people?
Yeah, certainly. And I think you hit on really good points there, centralizing all of the assets in one entity so we know who owns those client accounts, which is, the LLC in most cases. Taking it a step further, we often do work with the tax professionals like the CPA that you just mentioned to figure out the taxation of that LLC, because that has some implications as well when we think about bigger picture, what it means to a G2 investing in, is how their tax world is going to change with being an equity owner. So the most common taxation we see is, partnership or S corporation. There's obviously a few differences between the two, but some of them give you more flexibility. Some are a little bit more rigid, but come with more tax savings.
Well, and certainly on the other end of the spectrum from corporate or C corps is we see advisors that are still structured as a sole proprietorship, in which case
Yeah.
there is no business, technically speaking, for another person to invest in. It does need some type of entity structure, and they range from, like we said, LLC is probably the most common, but we often see and sometimes necessitate more complex structures where maybe there's an LLC, but the members of the LLC aren't even individuals, but other
Yep.
organizations, either LLCs or S corps. So definitely important to get good advice and counsel on the right type of entity structure. So certainly, that appropriate entity structure is that first of the 5 building blocks of sustainability. The second one, and we just kind of talked about this, is creating an investable organization. So Siena, I'll turn to you. Tell us a little bit about what it means to build an investable organization and why is this critical to sustainability?
Yeah, I want to echo some of the points that Eric just made. Silo book owners can walk away with those assets at any time. So that's a big risk when you think about, investing in this organization. So an investable organization has all of the assets housed in one place. It creates centralized cash flow, efficiencies because we're able to house everything together. It also is the vehicle for growth when we think about, M&A activity, for example, in an organic growth strategy. And it also holds value. And in exchange, the ownership team receives compensation. So we work with a lot of teams as really one of the main focuses throughout what we call the financial analysis stage is working on owners' compensation. So there's, a formula, so to speak. We love our math here, but we think about wages being paid to equity owners. We also think about profit distributions, equity income, and then also equity appreciation. So to break that down a little bit further, if I may, wages is split into 2 main buckets. We have, base salary for roles and responsibilities. We also have a bonus component in most cases. Wages, we often start with looking at benchmark information to help the ownership team divide roles between themselves and look at what peers are paying, for a CEO versus a COO, for example. Bonuses are really where we help you guys figure out what type of behavior you want to incentivize. Growth is a very common one. So how can we structure a bonus pool to tie to, the behavior we want to incentivize in the company? On
And
top of,
Siena, I want to
Mhm.
pivot just real quick here, and I know we're going to talk about compensation more in a
Yeah,
moment,
of
but
course.
I want to get a really important point across here. There is a way, correct me if I'm wrong, but we can structure bonuses without an eat what you kill model.
Yes, certainly. And we do recommend shifting away from the eat what you kill model in these ensembles because we want to make sure we know the level of profitability, again, being the most important value driver. that's really why we shift away from eat what you kill. But we're still able to incentivize some of those, growth mindset, for example, those
Right.
behaviors.
Yeah. So Eric, what we're getting at here is, talking about getting the business ready for those next gen investors. So in your mind, what are some of the top considerations for a founder to be thinking about to address for the business in order for it to become attractive to a future investor? I mean, we're really talking about something that's not much different than deciding what stock for someone to invest in. It's a very similar analysis. The only difference is these are privately held companies instead of publicly held companies, but a lot of the same principles still apply.
Yeah, they do. And there's a few things that Siena said that maybe we can explore a little bit further. I mean, one of them, Siena used the word ensemble, and I think a lot of people have heard the word ensemble, but they don't really know what it means, and they're not really structured as an ensemble. Which, my simple way of thinking, an ensemble just means you're one cohesive group that you all sort of rise and fall with the success of the group as a whole, not one person as an individual. So yes, you can have a bonus plan, you can be rewarded for certain activities or certain successes, but by and large, most of your success comes from, the team rising and falling with your combined success. So that's one. Another word you mentioned, Siena, was roles, which is one of the primary reasons people set up ensembles. And one of the reasons, people want to join a firm, which is there's lots of requirements to run a successful business. You have to be great at sales and marketing and investment management and, estate planning and all the things that your clients rely on. But you're also a business owner that needs to run a business. You need to take care of compliance, IT, payroll, HR. No one likes HR, generally fine. So what you hope is an ensemble, and as you're really building a true business, you're starting to introduce the idea of specialization. Don't have 5 people doing little pieces of all this. Find the person that's really best and maybe, likes doing HR. Or I'm working with a firm right now that's actually going to be merging with another firm. And one of their people really likes compliance, to which the buyer is saying, really? That's so fantastic, because none of us here like to do compliance, right? Perfect. Have someone, fit the role that they really like, highest and best use, and that's what you should spend the most time doing. So how do you get ready for next generation, Scott? You want to create, a real business versus having a bunch of silos. You want everybody compensated in a way that everyone thinks is fair. You want to make sure that your people really love what they do and hopefully love you too, because they're really spending a lot of time together. We equate it a lot to people as a marriage, right? You're going to be, spending some time getting to know them, then you get hired. And, for the first year or so, you're trying to feel each other out, make sure it's the right fit. As you get more serious, you're going into that engagement process. Am I ready? Am I ready to put that ring on my finger? And then finally, when you introduce the idea of partnership, you're actually getting married. So you want to make sure you have all the pieces in place before you make that big step. So you're asking your G2s if they like it, if they're fulfilled, if this is the right career for them. And they're asking you, are you the person I want to hitch my wagon to? So those have to be a good marriage. You need to, as you're starting to introduce this idea to people, you're actually starting to bring them into the management of the business. It's really hard to say something, I want you to be my partner, but our roles will stay exactly the same as they are today. What does that mean? Why become a partner? So that means starting to introduce, some of the financials, some of the decisions that the firm has to make at the corporate level. That can include hiring and, other major decisions, real estate, location, work from home policies. Is there a firm we talk to that doesn't have conversation and debate about how they want to operate themselves? So, all these types of things. One thing to keep in mind is this next generation advisor, they don't need to be a clone. If right now, if people listening are the G1s, the founders, you're thinking, I need to find this person or create a person in my own image because I really am the best. So the only way my clients will stay is if I replace myself with someone just like me. Could happen. There might be someone out there just like you. but more than likely, some fantastic skills and attributes one of your people has that maybe you don't. Or maybe when they're given the opportunity, you can watch how they flourish. They're interested in different ideas, new technologies. Maybe some of your younger generation advisors are really interested in ESG or sustainable investing, but it hasn't been an important topic for you, but this is going to attract new clients. All these things are areas you want to introduce.
Well, and I think, that's a great point, that a lot of advisors are accustomed to, founders particularly, they're entrepreneurial by nature. They started off wanting and feeling comfortable taking the risk of starting a business, and you don't necessarily expect an employee who chose to be an employee in the first place to exhibit those exact same qualities. What you actually want is someone with it, maybe instead of the mindset that you might have of, the buck stops here and I make all the calls. You need to hire someone and bring a partner in that is by nature more collaborative than you were. And particularly because as this business grows, you're going to probably need more layers of owners and a succession team, if you will, which all of them are going to have to be collaborative. So there's definitely going to be different traits that you're going to need in that second generation of owners of the business that weren't quite the same as the first generation.
That is so true. We always tell people in our consulting, you need to have multiple people available to replace, someone that's retiring or leaving the business. Why is that? Well, I'll give you two examples, from the last 6 months or so in our consulting. One firm had identified a G2, really nurtured them, thought they were ready, started to introduce this topic, felt very confident, and were shocked when this G2 said, you know what? I don't want to be an owner. I don't want the pressure. I don't necessarily want to work as hard as I see you work. That's not for me. I'm great being a role player, giving my clients a service. They love me, and I want to continue to do that. So that was a big surprise. Another firm we've been working with for a couple of years now, same type of situation. Had a person in mind, was very capable. Clients liked him. And when the transition process began, this advisor left, just left. How could that be? How could it be? People are unpredictable and you just don't know, especially people that, are in the younger stages of their career. So you need to have a couple people lined up.
Well, and one of the ways we can hopefully make them more predictable is with comp. So Siena, this is getting into really your area of expertise. So I want to start with you on this third pillar of sustainability, or this third building block, and that is redefining ownership level compensation. So you've designed countless comp plans in your career here, and so I want to get your opinion on this. What we find is that a lot of times advisors come to us and one of the first things they want to do is benchmark, how am I doing paying my staff? Like, am I above market average? Am I below market average? Am I giving them enough in compensation to attract and retain them? And that's a great line of thinking. But I think you would actually advocate for advisors to shift the focus initially to on their own compensation first as owners and then the staff. So tell us a little bit about why that's important.
Yeah, so I think it's important because we're able to create predictability against, the single largest expense on your P&L when you think about, how your revenue is being allocated between expenses, owner's compensation, and profit. So that's why we want to start with owner's compensation, because we're able to balance income for the owners between a few different buckets. We have the base compensation, which is relatively easy to tie to benchmark information because we can assign roles and help you guys establish those roles between the ownership team. But oftentimes people come to us and they think about their compensation just in the form of salary or just in the form of profit distributions, rather than thinking about the entire compensation picture, which is that component of base salary, potentially a bonus, your pro rata share of profit, but then also any proceeds if you're the seller in these transactions. We want to evaluate how that impacts your total compensation picture. Once we're able to establish owner's compensation, then it gives us more flexibility or understanding about how much profit there is left over to then start shifting and thinking about employee compensation and perhaps deriving a firm-wide bonus based on firm profits, because that's the incentive you want to build. You want a certain level of profit at the bottom line. So we start with owners' compensation to create predictability. But I think it's also a helpful tool when we think about, retaining and attracting other investors in your organization as well, because they know when they purchase equity, for example, they're not going to be, receiving a large pay cut to move forward with the opportunity. So I think it's also retention or recruitment strategy too.
Yeah, I think for a lot of those potential G2s that are going to be buying in, part of the reason why, when you get done with your work with them and we're showing them, this 10-year model of what this might look like, you're often not only having to convince the G1 and the G2 of the economics of this, but sometimes that G2 spouse might be a roadblock that they're like, honey, we've got a mortgage. We're both still paying off student loans. You want to take out how much more in debt to buy into this company? But we need to be able to demonstrate to them that, yes, we can do so, but we're now getting profit distributions and we're going to use that to help pay off the note. And that's what part of the calculation is, to explain that to them. So yeah, I think these are great points. And you've brought up some points that I'll talk about more later, but I even had to switch to my Sharpie because I wanted to make sure that what I'm writing down is etched in permanent ink. All right. So Eric, let's talk a little bit about our fourth pillar, and that's attaining steady, sustainable top line growth. So multiple generations of owners working together are often capable of generating far greater growth rates over a longer period of time than, let's say, a single experienced but probably aging founder might be able to do. So I want to read a stat to both of you and get your impressions on it. Leveraging the data that we've done, I looked ahead of time today at the last 5 years evaluations we've done at FP. So roughly 5,000 different valuations to look at the data points. And I wanted to compare side by side. What does it look like for a single owner firm versus a multi-owner firm? And one of the most astounding stats that stood out to me was that single owner firms over the last 5 years have grown net new clients by 9%. So not a bad growth rate, but that's what single owner firms have been able to do. Whereas multi-owner firms grew net new clients by 20.2%. So it's more than double the rate of net new client growth being a multi-owner firm than a single owner firm. So Eric, let's start with you. What do you attribute this significant disparity to?
Yeah, I think it's an amazing stat, isn't it? And what you're hoping is that when you make somebody an owner, that kind of statistic is going to play out for your firm as well. If it doesn't, you might be thinking, why am I making this person an owner? So there's on that point, we find that when that G2 becomes an owner, they feel very differently about the business, right? They've had a mind shift that it's not just me anymore, it's us. We're working with a firm right now, and their mantra is, we want to create a culture of we. Now, I love that, because right now they're seeing too much I in their firm. So if you are incented to bring in business and you can see how that will help you currently and how your profit distributions will increase, and really importantly, the value of your holdings, this item on your balance sheet, your ownership interest in the firm, is going up exponentially with the growth of the firm, that's really motivating, and people are going to work that much harder. So I think that's sort of factor number one. Factor number two is the outside world looks at a lot of people differently when they know you're a partner of the firm. They think, wow, you're an important person in the firm. You've made a commitment to this firm. I am more likely to hire you as an owner than I would be if you were my friend or acquaintance or a referral that was simply an employee, and you could be gone tomorrow for all I know because you're not fully committed. So that's the second factor. And I think the third factor is just reality, which is at a certain point in your life and career, you're going to slow down. And you've got a full book of clients probably. You're not interested in burning the midnight candle like you used to. And business development is no longer your key focus. So that first generation owner will eventually slow down. We hope you'll slow down, because most of you won't make it to old age unless you do slow down. So you need some of the younger generation to come in and help you out.
So, Siena, what did you think of that stat?
Oh, no, I thought that was pretty amazing. I mean, I've seen some of the numbers, if I have clients coming back after for tranche two or tranche three, which means, the second or third transaction, I can compare some of our analysis to what we started with when they were a single owner. So I've seen some of that, but I love to see it reflected in, a larger statistic, of course. And I really want to hone in on what Eric was just adding about, the capacity when you're able to continue to grow with, you're able to split the tasks amongst, the ownership team, certainly, but I think it also gives you more flexibility to go out and build out that support staff as well. So you're able to go hire that COO that you need to continue to maintain the business and run the business successfully and take some of that burden off of your shoulders. So it helps you define roles between individuals and it gives you that extra capacity as well. And it's motivating for G2s because they think about profit as a way to finance their debt, like we were just talking about, and bolster valuation, like Eric just mentioned.
Well, and I think that's part of what the value they get out of the modeling work that you do is they see, you might help them calculate how long do I need this note to be for based on, current profitability. But the math works out that if there's more profits, they can pay that note down faster. So
Yeah.
the people who have just bought in are about as motivated as anyone to increase profits because they can pay down that note faster. They can get rid of their debt sooner and then buy into to more equity. The other thing, and we've seen this in our work too, is that sometimes those G1s, when they see the G2s step up and start to grow, they get what we call the rejuvenation effect, and they start being excited again. And maybe they've taken some of those responsibilities off their plate. They now have more capacity to go out and bring in new clients that they didn't have before because they were doing everything themselves. So there's a lot of factors that go into this. And I think the final one being, and I'll use my own example here, I did not hire my parents' advisor. My parents' advisor does not have a successor. And so I'm not going to go out and hire someone where I'm going to have to hire another advisor down the road when I know that advisor who's older than me is going to retire. And so we've seen a lot of our firms that when they communicate this change or this addition to the ownership team, referrals just start clicking all of a sudden because people are now willing to go and work with an advisor that they know this business is sustainable.
Yeah. Scott, there's another, what I'm going to say is a more nuanced reason I think that statistic holds true, which is people want to work for a firm that has multiple owners because it demonstrates to them there might be a chance for me to become an owner sometime too.
Right.
And there's not a firm that Siena and I talk to that doesn't say my greatest challenge is in finding great talent. And once I find them, keeping them. How can you help me with that? So, we're not recruiters here, but we can definitely help set a structure up to keep your people motivated and engaged and hopefully there for a career. So, for example, one thing we always recommend is have the existing partners commit to a piece of paper what the elements are they're looking for in new partners. It's a very valuable exercise to make sure all the partners are on the same page. Then share it. Share it with some of your G2s. Maybe they're not ready to become partners yet, but you think they've got the stuff that it's going to take, and you want to let them know that that possibility exists at your firm. So you get greater loyalty, greater engagement, easier time recruiting people, and in the end, it all results in greater growth and profit.
Absolutely. All right, let's finish with our fifth and final building block to sustainability, and that's generating higher levels of profitability. So we've got the right entity structure in place. We've kind of shifted our mindset. We're thinking about top line growth, getting out of the eat what you kill model, and working on compensation. All of this should therefore lead to higher profitability. And Siena, I know that your work as an analyst here, and especially for a lot of our appraisers and their point of view, the bottom line of the P&L is the starting point in building a valuable enterprise. We often advocate for the rule of thirds, and you mentioned it quickly. You talked about buckets earlier, the 3 different buckets. So I want you to go a little bit deeper in that for us. So explain this kind of rule of thirds, give us some context as to what you see most often in your work and where many firms are when you first work with them, and what's genuinely attainable.
Yeah, so to start with the rule of 1/3, we think about how revenue is allocated between the company expenses, which we would include all of the overhead, so your rent, Wi-Fi, phone, etc., and all of your support staff salaries in that first bucket. So about 1/3 of revenue in bucket number one. We want to allocate about 1/3 of revenue into owner's compensation. So that's, any salary and any bonus. And then that leaves 1/3 of revenue at the bottom line as profit. Again, really emphasizing that profit margin because that's the return on investment that investors have or G2s have when they buy in. But then it also supports and it brings parity between some of the different valuations. For example, that market-based valuation when we have a 1/3 profit margin. Firms come to us, as you can imagine, with all different sorts of profit margins. We have, the firm that is at 1/3 because they've been through this before with us, and so they've been targeting that for a few years. We also have the firm who is lower than 1/3, maybe at, a 20 to 25% profit margin. So what we do in those cases is we help you guys figure out a plan or a trajectory in terms of how we can achieve that 1/3 ratio. It might be an exercise of going through the P&L to flag any expenses that you're paying way more in marketing, for example, than your peers, or there's discretionary expenses on that P&L that we can normalize. Or it could be a matter of just investigating why we're arriving at a 20% margin. So for example, have you done an acquisition? Are you supporting some debt? Or are you staffed for growth? In those instances, that tells us that you're able to achieve that 1/3 ratio sooner because of the investments that you've made over the past few years. On the flip side, we have some firms come to us with a higher profit margin in, maybe the 50% range. That's less common, but it has happened before. And the trend that I've noticed personally is that a lot of times they're understaffed. So they're not investing as much in their support staff or their owner's compensation, which makes it really hard to have that capacity to grow, especially during market fluctuations.
Now, when you deal with a firm that maybe is even lower than 20%, I think that's the point, is maybe 20% kind of that point where we would say that business is almost uninvestable because basically that G2 is never going to get enough profits to pay off the note.
Yeah, it's a little bit of a tricky conversation when we think about, numbers and how that translates to a deal, which is where some of our spreadsheet modeling comes into play, because oftentimes that 1/3 ratio supports a reasonable payback term length on a promissory note. We like to target about a 7 to 10-year payoff. So if you have a profit margin that's less than, the 20%, you might see term lengths extending past 10 years, which is usually not a great incentive for someone buying 5% of equity. But it also isn't that great for the G1 either because they know it's going to take longer to get out of the business eventually. So it's not a fun conversation to have in some cases, but that's where the spreadsheet can illustrate those concepts. And we can say, is this growth rate achievable? What can we do? Can we focus on an acquisition as an inorganic growth strategy to increase revenue and increase profit? But sometimes it is uninvestable. And that's where you kind of go to the backup plan in most cases, which is, thinking about, can I sell my business and stay on as an employee? So more so some of the M&A activity as being that, trigger, so to speak.
Okay. So when we think about, all of these 5 building blocks, what we're talking about is creating a path to partnership. So everything we've described so far really comes down to this. And I'd like to finish up our discussion today on how does someone get started, offering our audience some concrete takeaways and some calls to action. And some of this is frankly uncomfortable. And I know that, both Siena and Eric and a lot of the work that they do have to have difficult conversations with some of our advisors, but it's one of those, you got to break a few eggs to make an omelet. So Justin as advisor might have their struggles, getting clients to talk about insurance and estate planning. These are vital discussions in financial planning process. And when we're talking about building a sustainable business, we need to have some of those same types of conversations. So what the business needs to be sustained from is the inevitable exit of the advisor. So hopefully, that is a carefully planned voluntary exit from the business versus a sudden unexpected one. But both scenarios, need to be accounted for in this process. So, business planning and exit planning are truly one and the same. And I really want to repeat that because I think this is a really important takeaway from our discussion today. Business planning and exit planning are one and the same. So like the work you do with your clients, the sooner they come to you to do that planning, the more options that they have. So if you've got a client or a prospect that walks into your office and they're 60 years old and say, I want to retire at 65, can you help me out? And you go, well, yeah, I probably could have helped you out more if you came in 20 years ago, because then we'd have more options. And for a lot of advisors, you actually have 8 ways as a small business owner, there's 8 ways you can exit your business. But if you don't start planning soon enough, you might be limited to just 1 or 2 choices. And so for the founder of independent financial service businesses, the first step in this path to partnership is by assessing your business attractiveness to another investor, whether that's an internal or an external investor. And the best way to do that is just answer the question, can this business run tomorrow as well as it does today if I'm not here? If the answer is no, well, you know where you need to get to. The next question then is, am I financially and emotionally ready to stop working at some point in time? And you see this with your clients who might struggle with their identity and the time that they have on their hands after they retire. So be thinking about that ahead of time. And Eric, I know this is something you encounter in the consulting engagements you do with our clients. So some of them want to die with their boots on. Others might want this glide path to retirement. Others want to reach a point where they just want out as soon as possible. So how do you handle this kind of assessment phase of sustainability discussions?
Yeah, it's it's really, as you said, it's just a lot of sort of deep conversations about what do they want, what are their motivations, what are their timeframes, do they have the structure in place, do they have the people in place, do they have the right compensation systems, everything we've discussed so far. We need to assess to see what are the strengths and weaknesses. It's our version of a SWOT analysis, and help them attack those areas that really need to be improved, to have that multi-generational, hopefully equity-centric, long-term business that, is what ultimately they want, their clients want, and their staff wants. So that's the way we start the process. I equate it a lot to the financial planning process I always went through as an advisor myself, right? There's a period of discovery. We need to evaluate everything we learn. We need to discuss it with the firms that we work with. We need to come up with a plan and a set of recommendations to solve any weaknesses or to pursue the areas that they want to go to. And, and that's just like your financial planning process. So if we ask any advisor or any advisor's clients, where's the financial planning process break down? It's not that you're not good financial planners. It's that your clients didn't implement, right? Why don't they implement? Seems obvious to us. And it's the same thing for you and your firm. You need, and it's hard to do it on your own, which is why so many people leverage FPTransitions. You need someone to help you put together the implementation plan, hold your hand through it, create the roadmap, because there is a roadmap there, for most firms. If there's not, and that happens occasionally with us, the plan B generally is you need to find a partner firm. You need to find somebody to merge with that's going to help bring your firm, your staff, your clients, to the next level. But most people we work with are trying to do it internally first.
And Siena, oftentimes after Eric's done that assessment, we've made the determination that internal is the route to go. That's usually where you kind of step in. So if you would just kind of, take us behind the curtain a little bit and talk about concretely, what are some of the things that you're doing to kind of help with that building of sustainability in your line of work?
Yeah, certainly. Well, I think it starts with understanding, the company cash flow. So we start by, of course, putting together a forecast, looking at things like, growth, revenue, expenses, owner's compensation, and profit. But then we're able to layer in the transactions and figure out if we adjust this deal term, what does this mean to the buyer? Seller, look at your profit distribution going down, but look, it's being replaced by receiving interest and principal payments from seller financing a transaction. So to summarize, we kind of start with just base case, look at evaluating the company financials, and then layer on the different transactions or different, objectives that Eric and his team were able to identify in the assessment phase.
Awesome.
We also present the plan to G2s in a lot of cases too. So we kind of are that third party to help you in the presentation to get them on board, so to speak.
Right.
Yeah. I'll just add one more point on this because I know we're getting near the end of our time. I can't tell you how many times I've heard from people, my business is too expensive for anyone to buy out, any of my G2s to buy out, which I think, Siena and I shudder at. If you've structured it properly, if you have the right compensation system, if there's enough profitability built into your firm, they can buy you out, whether you help them with owner financing, whether you go to a bank or a finance company. It's profitability that drives somebody's ability to buy you out. So I hope most people don't think, I'm just too expensive for my next generation to buy me out. Talk to us. We'll show you a path forward.
Great advice. Love that. That's a good kind of final thought for us. I think the sooner that you can make the conscious decision to have a sustainable, enduring business, the more options you're going to have, the more likely you are to experience the growth that you want to have, and the more value that you're going to be able to create in the business. So on that, I want to thank everyone for joining us today. If you are currently an independent financial advisor or considering becoming one, we'd certainly like to help you identify, build, and realize the equity that you've created in your business. FPTransitions is eager to support you. So let's have a conversation. You can visit our website at FPTransitions.com. And when you get there, just start scrolling down the page. You're going to see a schedule a consult button pop up at the bottom left. Help us find a time that works for you. We'd be happy to answer any questions that you have about any of the topics we've talked about here today and the content we've discussed, or anything we didn't cover as well. So I want to thank you for your participation, and we look forward to seeing you at our next event.
Great. Thanks, everybody.
Thank you.
Thank you.